Hey guys, it's Jeff Copeland, the Multifamily Guy. I'm a real estate broker and property manager in St. Petersburg, Florida, and the owner of Copeland Morgan LLC. So if you've been looking for rental properties, investment properties, single family, multifamily, or otherwise, at some point you kind of have to pop the hood and start crunching some numbers. And so that's what I'm going to talk about today is how to analyze the operating statement of a potential investment property. I'm going to look at some actual numbers from an actual listing and plug those into a spreadsheet, a calculator that I use. In order to get there, though, first I want to talk a little bit about some of the key metrics that you need to understand as real estate investors. And I talked a little bit about the tool that I use. It's just an Excel spreadsheet. These are not secret formulas. They're widely accepted metrics that are used across the real estate industry. There are tons of free tools and free calculators you can download online. BiggerPockets has some great ones, but personally, I prefer to use my own because I think it's very important to not just use the tools, but to understand how they work. You really need to understand these metrics and these formulas, and they're not complicated. It's simple math, addition, subtraction, and a little multiplication and division. But when you understand what these metrics mean, that's when I think you can truly grasp the performance of a rental property and analyze it accordingly. So moving right along, we got a lot to cover here, so I'm going to go a little quickly. I have to give credit to a former real estate broker that I used to work for when I first got my license. His name is Bob McDougald, and he taught a class called How to Speak the Language of a Real Estate Investor. And this is the example that he used. Let's say that I have two boxes for sale. I've got a yellow box and I've got a green box. My yellow box spits out $800 a month, and my green box spits out $1,200 a month. Which one do you want to buy? Now, some of you may have naturally said, well, I want the green box. It spits out more money. But obviously, we need a lot more information here about these boxes before we decide if either one of them is useful as an investment vehicle or which one is the better investment. One of my first questions is, well, is that the gross income or is that the net income? Are there any expenses associated with that $800 a month or that $1,200 a month? So the answer is yeah. Well, actually, in my yellow box, we have to plug it into the electricity, and that costs us $200 a month. So you actually net $600 a month or $7,200 per year. On my green box, it runs off of water, so I have to hook it up to the water main, and it actually costs me $366 a month. And you end up with $833 a month net, or $10,000 a year. Now, which one do you want to buy? Some of you may still be leaning towards the green box, but we still don't know a very important piece of information here. How much am I asking for these two boxes? So you quickly come to realize that the net income from an investment is really only useful as it compares to the cost. So now if I add the price to the equation, you can see that my yellow box, I'm asking $72,000 for it. And remember, it produces $7,200 a year in net income. Whereas my green box, I'm asking $150K for that one, and it produces $10,000 a year in net income. So you can pretty quickly see here that the yellow box, priced at $72,000, produces $7,200 a year in income. That's 10%. So 10% of my cost I get back every year in income. That is the capitalization rate. That's a cap rate. It can be for a rental property. It can be for stocks and bonds. It can be for precious metals. But basically the income divided by the cost is the capitalization rate. So this yellow box basically produces a 10 cap. It has a 10% capitalization rate. Whereas my green box over here, if you take 10,000 and divide it by 150,000, produces more like a 6.6% capitalization. So now, and another quick obvious math you can do is, well, I could buy two of these for $144,000 and I'd have $14,400 a year in income. That's still less than the $150K you're asking for the green box to get $10,000 a year. So clearly I'd be better off buying two yellow boxes than I would buying one green box. So hopefully that helps to kind of simplify things and bring it down to the bare basics that income is only interesting as a factor or as it compares to the cost of the asset. And there's what we just talked about. On $7,200 a year in net income at $72,000, that's a 10% capitalization rate, whereas over here at $10,000 on 150K is a 6.6. So which one would you buy now? We already talked about that. Clearly the yellow box is the better deal based on cap rate. Now I'll take this a quick step further before I move on, but what if the yellow box needs $50,000 worth of rehab? It's completely shot, it needs a new roof, it needs new AC, it needs new plumbing, it needs $50,000 in work just to get it, up to par. Whereas the green box is brand new. It's new construction, completely renovated, turnkey, 6 cap, or a money pit at a 10 cap. My point being, it just depends. You have to do this analysis and dig down into the metrics and the numbers on properties or any investment vehicle to figure out which one makes the most sense for you. And while you may prefer the green box, completely renovated, and be happy with a 6.6 cap, investor B may be quite happy to take on the 50K rehab in exchange for the 10 cap. Different properties and different investment vehicles make sense for different people, but you have to understand these numbers in order to figure out if it makes sense for you. So moving right along, I want to run through a couple of formulas that you really need to master as a real estate investor. And then we're going to jump over to my analysis spreadsheet and look at some actual income and expenses from an actual listing and figure out how all of this shakes out when we're looking at a rental property's operating statement. We already talked a little bit about the capitalization rate, or cap rate. It's the net operating income of the property as it compares to the acquisition cost, like we talked about with the boxes earlier in the video. It basically is an indicator of the performance of the property when we factor in the gross income and all of the operating expenses to come up with that NOI, or net operating income. The formula is the net operating income divided by the purchase price. And this is a core metric for investors. It looks at the actual net income from an investment as it compares to the acquisition cost or purchase price. Another quick note about the capitalization rate: it does not include debt service. That trips a lot of people up, so I'll take a quick moment to explain why. Debt service is not an operating expense. It has nothing to do with the operation of the property. The debt service does not affect the rental income, and the debt service does not affect acquisition cost of the property. So the property performs the same whether you pledge it as collateral for a loan or not. Debt service is not an operating expense because it has nothing to do with the operation of the property. Now, debt service is still important. It's a critical metric, but we'll get to that in a moment when we get a little further down beyond the cap rate and start to look at our equity dividend ratio or our cash on cash return. Now, another quick little tool I want to jump to is what happens if you don't have all the expenses. And this is very, very common. You'll see a listing and you'll see that it's rented for $1,000 a month. So you know it's got $12,000 a year in gross income, but you have no expense information whatsoever. So how are we supposed to figure out the cap rate when all we have is the price and gross income? And when you do this many, many times, at some point you will realize that a well-managed property is going to run at about 50% of its gross income, going to get eaten up by expenses. And so a handy tool that many investors use is this 50% rule. If we know what the gross income is on the property, if I know it rents for $1,000 a month, you can safely bet that roughly half of that is going to get burned up by operating expenses. And so I would take my gross income times 50%. So if it rents for $1,000 a month, that's $12,000 a year. I'm going to cut that in half. That's $6,000 divided by the acquisition cost. And that will give me a very close, usually a very close approximation of the cap rate without knowing any of the actual expenses. I know they're going to be somewhere between 45 and 55% typically. And if you see a property listed that is showing 19% expense ratio, they probably missed something, because that number should be somewhere around 45, 50, 55% on a typical average investment property. Another rule that you hear tossed around quite a bit is this 1% rule. What is the 1% rule? It's really nothing but a quick screening tool. It's kind of like checking your blood pressure. It doesn't tell you if you're actually sick, It just tells the doctor if they need to dig a little deeper and figure out what's going on with your circulatory system. So the 1% rule is basically just looking at the listing or the asking price of a property and trying to figure out if 1 month's rent is at least 1% of the acquisition cost. So on a $100,000 rental property, I need to see at least $1,000 a month in rental income, or I'm done. I'm not looking any further, because again, when you do this 100 times, 1,000 times, you start to realize that if it's not making 1%, it's not worth really digging any deeper. It's not going to work as an investment. Either the price is too high or the rental income is too low, but if it's not beating the 1% rule, it's probably not going to look good on the bottom line. So basically the 1% rule is sort of a tipping point at which an investment property might start to make sense as an investment. That still doesn't mean it's a must buy. It just means, oh, it's a $100,000 house and it's bringing in $1,200 a month in rental income. Let's analyze it a little bit further. So now that we've got those little hacks out of the way with the 50% rule and the 1% rule, we can get back to our discussion about debt service. You'll remember I said that debt service is not an operating expense. It has nothing to do with the actual operation of the property. It doesn't change the income and it doesn't change the cost. Those are the two things that factor into our cap rate. But if you're going to leverage a purchase, if you're going to go in with 25% down on a property, you have to figure out, will this property cover the debt service with the operating income? So there's a ratio that we look at for that, and this is particularly true for multifamily properties and for commercial multifamily properties. Lenders, in particular, when they're underwriting a loan, want to know the debt service coverage ratio, and it basically tells us how many times will the net operating income, after you pay all those operating expenses, how many times can you cover the debt service? If it's less than 1, then you're in the hole. It's not going to work. Most lenders want this to be a 1.3 or better. And the logic there is if your net operating income can cover your debt 1.3 times, well, if the market declines, or if you have an extended vacancy, or if you have a fire, or something bad happens to stress your property, you're still going to be able to cover the debt service. A debt service coverage ratio of 1 basically means you're breaking even every month, and you're way too thin. If something goes wrong, you're in the hole, or you're shoveling money into your debt service payment. So it's a key metric for multifamily and commercial loan underwriters. They want to see the property's operating income can comfortably cover the debt service, even if there's a stress on the property in the form of a natural disaster or a market decline or an extended vacancy or something like that. And then the last one we're going to talk about is the break-even ratio. And what that looks at is basically what percentage of occupancy do I have to maintain to cover all my expenses, including my debt service. So you take the operating expenses plus the annual debt service, and you divide that by the potential gross income of the property, and it tells you, well, at 75% occupancy, you break even. And you don't want to see that number to be really high. You don't want to see, well, you've got to make 102% occupancy in order to break even. Obviously, it's not possible to have 102% occupancy. So a lower break-even ratio is obviously better. This basically tells landlords and lenders what percent of the units must remain occupied throughout the year to cover all of the property's expenses. It's a gauge of the property's performance under potential stressors, like we talked about. It can also be useful when planning vacancies for renovation. So if I have a fourplex and I know I need to renovate each one of my units and it's going to take me a month, but I know my break-even ratio is 75%, well, I'm golden. I can basically take one unit out of service and still break even. Now, obviously, you got to pay for the renovations and stuff, but at least you're not going to be going in the hole on your operating expenses and your debt service. So now that you know what all those metrics mean, and obviously you can rewatch the video and crunch some numbers on your own calculator and wrap your head around those, but I truly believe that you need to understand each and every one of those metrics as a real estate investor so that you can understand these numbers and not just plug them in and trust that somebody else's calculator is going to give you all the right answers. But now we get to the fun part. We are actually going to take those numbers, plug them into a spreadsheet for an actual property, and figure out if the property makes sense or if the numbers look good on this property. Now, I'm using an actual 5-unit multifamily property that is currently listed in our MLS. I have changed the address and the names to protect the innocent. This is a 5-unit multifamily listed at $499K. and it has $4,125 in total gross income potential on a monthly basis. You can see here are the rents. It also has $200 worth of laundry income for a total of $4,125 per month on a $499K asking price. Now, some of you are already thinking, but wait a minute, that's not even 1% of the purchase price. It would have to bring in at least $4,900 a month, or $4,990 a month to make any sense. So why are we analyzing it any further? And that is correct, but we're going to do it anyway so that I can show you why it doesn't make sense below 1%. Now, another thing I want to point out here, these are the actual expenses given to us in the MLS for this listing. You can see the only expenses for the property are water, sewer, and trash at $550 a month or $6,600 a year, and then insurance at $3,800 a year. So apparently, the seller does not pay his property taxes. He does not pay any management fees. He never repairs anything. What I'm getting at here is there are a lot of expenses that are missing from this operating statement or this income statement that was provided to us. They're saying they have $49,500 a year in gross income minus these two expenses, and they've got $39,100 a year in net operating income. That's an advertised cap rate of 7.84%. That's pretty good. A lot of people would jump on a property that's pushing close to an 8 cap. However, those of you who are savvy and are watching my videos understand that they're missing some expenses here, and we've got to plug those into our own tool to figure out what the actual cap rate is going to be on this property. So now I'm going to jump over to my spreadsheet. You guys already know what these formulas mean, but we're going to take these numbers and plug them in and add some of those missing expenses and figure out how this shakes out at the bottom line. So going back here to my rental property operating statement analysis spreadsheet. And by the way, I'm happy to share this spreadsheet with anybody who wants a copy of it. Shoot me an email or text me or whatever. Like I said, none of these are secret formulas. They're all widely used in the industry. I just happen to have put them all into a spreadsheet that I like and that I understand. So going back to the property we just looked at, the asking price was $499K. In this case, I'm not going to worry about closing costs or repair costs. We're just going to analyze it based on the asking price. And you remember the total monthly income from all units, including the laundry, was $4,125, which gives us that $49,500 number that they used. Now from there, you always need to account for vacancy and collection losses. I'm using 8%, which is maybe a little bit high in this current market, but it may not be high in other markets around the country or at different times. That basically means that we can have 1 month out of the year of vacancy in each of our units, which would be 8% of 12, of the year, and still end up at our effective gross income of $45,540. You're never going to run at zero vacancy, so you have to use something here for vacancy and collection losses. And I find that 8% is pretty realistic, but is also a comfortable number to use. There are no HOA fees on this property, so I'm ignoring those. Those are zero. Management fees at 10%. Those were missing from the statement that was in the MLS with the listing. Even if you self-manage, you should be paying yourself 10% as a management fee. A couple of reasons for that. It's earned income, which is taxed at a lower rate than your passive income. And obviously, it's something you need to account for at any rental property because you may not be able to self-manage forever when you start to scale up. Property taxes, we know they're going to be due, and we know they're going to go up. Usually in year 2, after we purchase the property, the tax assessor or the property appraiser is going to say, oh, you bought it for $499, we've got to reassess. So what I use here is a formula from my local county's property appraiser's office that tells me approximately what the taxes are going to be in year 2. So I account for that here. I would encourage you to go to your county or go to the county where the property is that you're analyzing and get the formula from them. At least get something that's close and accurate so that you can calculate your taxes. A lot of people get tripped up on this because they use the tax bill for the current owner from last year. There's a couple of problems with that. One, it's a year old already, and 2, you're going to buy the property this year maybe at 2 or 3 or 4 times what the current owner paid for it, and the county is usually going to reassess it the following year. So keep that in mind. we have to factor in something for repairs. In the absence of a 2 or 3 or 4 year history of actual repair costs, in my spreadsheet, I'm using 5% of my effective gross income. And I know that on a 5-unit property, $2,200, $2,500 a year in repairs, that sounds realistic. They may be higher some years, they may be lower some years, but what we're looking for here is an annual average. According to the listing, the owner of the property, the landlord, doesn't pay any electric bills. If there was a house meter or a laundry room, then they should be. I don't know how it's configured, but I'm wondering now if there's also an electric expense that's missing, because we saw that they had $200 a month in laundry income. So somebody's got to be paying the water and the electric bill for the laundry room. So realistically, you'd want to do a little digging and figure out if you need to plug in 50 or 75 or 100 bucks a month here for electricity for the laundry room. For now, I'm going to assume it's paid by one of the tenants because it wasn't given to us. I'm going to leave it at 0. Water, sewer, and garbage, that was given to us in the listing at $6,600 a year. Insurance was given to us in the listing at $3,800 a year. I would encourage you to get some quotes because you might be able to get cheaper insurance, or you might find the insurance is double because you're buying it for $499. He may have it insured for $3,800 a year, but maybe he paid $250 for it 5 years ago and he doesn't have it insured up to its current value. So do a little homework on your insurance, talk to an insurance agent, make sure you use a realistic number here. And then a reserve for capital expenditures. We know for a fact you're going to have to replace the roof, you're going to have to replace HVAC units, you're going to have to do plumbing repairs, you're going to have to buy big, high dollar, big ticket items that last 10, 20, 30 years. A roof is a perfect example. You might spend $10,000 on a new roof for this building, but that roof is good for 30 years. So you don't want to show a $10,000 hit in the year that you replace the roof. You want to take that $10,000 and divide it over 30 years and use that here as a reserve for capital expenditures as part of your operating statement so that you kind of balance those capital expenditures out on an annual basis. That gives us total expenses of $28,387 and an expense ratio of 57%. Now, I told you expenses should come in somewhere around 50%, so that seems a little high. We're going to leave it at that and continue with our analysis. That gives us a net operating income of $17,153. Looking at the 1% rule, that's only 0.83. That's below 1%, and we already knew that was bad. We talked about that at the beginning. And that gives us a cap rate of 3.44%. That's not exciting at all. So if we were not going to finance the property, we would stop right there. We know that we're only going to earn 3.44% out on our $499K. Now, there are times and there are people who are quite happy to take $500K that's sitting in the bank doing absolutely nothing, park it in a multifamily and earn 3, 4, 5% on it. But most of us are looking for better returns than that. Now, let's assume that you are going to finance it. We've got to look at some of those other metrics that we talked about. Our mortgage balance year one at 75% is going to be $374,250. The year one debt service at 5.5% on a 30-year amortization is going to be $25,499. Red flags should already be going off right now. I just told you our net operating income was $17,153, and now our debt service is $25,500. That obviously puts us in the negative to the tune of about $8,300 a year. So I can tell you with certainty that this property that was advertised at an 8 cap at $499K is going to lose you about $8,000 a year. So there's no way I would recommend that you buy this property. You would be cash flow positive if you bought it all cash. You're going to be $8,000 in the hole if you financed it at 25% down. As you can see, that gives you about a 67 or a 0.67 debt service coverage ratio, meaning your net operating income after you pay all your operating expenses only pays about 2/3 of your debt service, and your break-even ratio is almost 109%. Well, it's not possible to have 109% occupancy, so this is a total no-go. You're actually going to lose almost 7% a year on your 25% equity. Now, let's say we really love this property and we want to know, well, at what point could we buy it? What offer would make sense? And I already kind of played around with this and plugged it in, but on this $499K ask at $376,000, it actually starts to break even. And you can see these numbers here for yourself. I won't go through the spreadsheet again. The only real changes are the taxes go down because the purchase price was less. Everything else stays roughly the same as far as expenses go. That gives us a 53% expense ratio, almost 20K in net operating income. But guess what? Our debt service is 19,214, whereas our net operating income was 19,244. We're earning a whopping $30 per year on our investment of $376,000, or at least 25% of that, which was our down payment, which ultimately gives us a 0.03% return on this cash. You'd be better off putting it in a savings account. But the cool thing about this tool is, what if we found another property that's very similar, it's got all the same features, all the same expenses, but it's priced at $299,000. Plug in that number up here at the top. Let's say this is now property B, everything else being held constant. It produces a 7 cap. It throws off $5,000 a year before tax cash flow. Gives me a debt service ratio of 1.35, a break-even ratio of 81%. So at 81% occupancy, I'm paying everything and I'm free and clear. My cash-on-cash return is 7%. So a healthy purchase on this property with these operating parameters would be closer to 300K. Why they think they can get 500 for it is beyond me, but I'm telling you, this is an actual listing that's currently in our MLS, and I see it all the time, prices that are completely out of line with reality. So on this 500K property, I would realistically give them 300K for it. Now, would I waste my time putting in an offer $200,000 below asking? No, they're probably never going to take that. I'm just not going to tell you to buy it for 500. So I hope that helps to put all these numbers together for you. I know this video is getting long, so I'm going to wrap it up. But I hope those metrics start to make sense to you. I encourage you to really get to know the numbers and how they work and how they impact each other. And I find that this is a great tool to plug in different prices, plug in different expenses, and figure out if a property makes sense or not.